And have a listen to this. Have a listen to this.
Interest rates are higher, and people don't like that, but you should be welcoming a stronger economy.
And maybe a deal has a point about the machinery of capitalism being oiled with the blood of the worker.
The United States is a country that has always paid all of its bills.
Lannister always pays his debts.
Don't let the bastards get you.
Hello and welcome to Comedian versus Economist. We demystify the world of money and help you get a handle on the bigger picture. My name's Adam and we're joined as always by my little older brother and real-life economist, Thomas. Hi, Thomas.
Yeah, g'day, Adam. How you going?
Doing very well, thank you. Fresh back from a trip to Tasmania. I went to Hobart for a couple of days, which was great. Never been before. Went to Mona, actually, the Museum of Old and New Art. Owned by David Walsh, who's a very famous art collector after making a lot of money making a sports betting and horse race betting algorithm. And so he made tons of money doing that, maybe started out card counting. Anyway, as we were walking through the museum, my wife Anna pointed out that was his living room upstairs. I didn't realise that he kind of spends a lot of time there. He lives there. And I'm like, imagine if we ran into him. Sure enough, he was at the bar. He was at one of the bars. So, yeah, went and introduced myself. I'm sure he was dying to meet me. We compared sports betting tips, racing strategies. Apparently selecting race 5, number 5 in every meet is perhaps not the most finely tuned strategy, but still it was good to swap notes.
The number 5 is your lucky number.
I know. But unfortunately, not the secret to millions of dollars in success. Anyway, but massive show coming up, as always, Thomas. The banking crisis is dead. Long live the banking crisis. Like Brangelina and Benefer, lithium in Chile is now so popular it's simply known as Chilithium. We'll take a look at what's going on. Maybe uncover Chilithium's sex tape or something.
There's absolutely zero information in that introduction about what we're going to be talking about.
Oh, rubbish, Thomas, rubbish. Speaking of rubbish, Cleanaway. Still in trouble? No. Bin night is back on, baby. But first, my economic prediction from last week came true, Thomas. You might remember. I predicted that economists were terrible at forecasting.
Oh, yes.
And so it was. The economic community collectively held the RBA's beer while it dropped the bomb with another rate hike.
Yeah.
Thomas, you and 21 out of 30 other economists thought we were done with rate hikes. What's going on?
Yeah. Well, at least I thought the pause would last a little longer. It's it's a little bit unusual. Like it feels a little bit all over the shop to be hike for 10 months, pause, hike again. Like it's reasonable. That's fairly unusual.
You never know what Phil's going to do. This is his strategy. He keeps people on their toes.
It does. Oh yeah. Everyone was scratching their heads over it. I mean, the interesting thing is like there was really no new data between April and May that suggested that a rate hike was back on. So we had the employment data, which was like more or less as expected. We got March quarter CPI, which was weaker than expected, if anything. So there was not like they were responding to any data in the Australian sector. And when he sort of in the press conference afterwards, he's saying that he said there were 3 things that the RBA had observed, further evidence that Australia's labour market is still very tight. Well, yeah, we knew that. That didn't change. Services inflation is uncomfortably persistent abroad. So that's kind of interesting. Like that's sort of like, we're saying like if we got services inflation in the US, is that the story? Is it for the same reason we've got services inflation here? That's not entirely clear why we're now looking abroad, or like definitely like the situation abroad didn't change in a month. Like still, that's shouldn't be shifting your view on 1 month of data there.
Right.
You're laughing. Why?
Oh, I just feel like we're gonna I'm hoping number 3 is gonna be like and there was also like magical fairies stealing biscuits in the kitchen or something. And there's like a big reveal where it turns out that Phil Lowe and the RBA are just kind of seeing things or on some acid trip or something, and it's like a big. It was all a dream.
Well, no, the third thing he's pointed to is that asset prices, including the exchange rate and house prices, are responding to changes in the interest rate outlook.
Right.
So what he seems to be saying there is that house prices are lifting. We saw house prices lift in March and April. Sydney house prices are now growing at 3% over the quarter. So like you annualize that, that's 12%. That's booming. So Sydney house prices are off and running.
Yeah.
And he's saying that seems to be coming from an expectation that we're going to get rate cuts, that rate cuts are coming quickly.
Right.
That creates a little bit of a problem for the RBA because there's something called the wealth effect. So as house prices go up, households feel wealthier and they start spending more. So that pumps your economy along at a time when the RBA is trying to slow it. So that seems to be what he's responding to. But none of that's particularly convincing. None of that is view changing, I don't think. It's not. Yeah, right. He's just saying like it was a balance. It was finally balanced in April. It was finally balanced in May, and they just went for it. But I mean, probably the most likely outcome is that the banking crisis, which we'll talk about in the next break, was sort of kicking off. Was kicking off, and I think there was a bit of like, well, maybe we should just wait and see how this plays out before we start hiking. And then once it was like, okay, now it looks okay, we'll hike. Then, funnily enough, now it looks like it's back on again. So,
I did call out when we came back from a couple of weeks off that the RBA obviously leans pretty heavily on information that they get from Comedian versus Economist, and that was quite likely the reason that they paused the rate hikes because in our absence, Thomas, they had no idea what was going on in the world of economics. So now that we've resumed normal programming, it's no surprise to me, at least, to see that they've resumed their rate hike program because they can now have confidence that they understand the bigger picture.
Yeah. No, the 4 data points we offer each week really paint a clear view of economic conditions. A few lols, yeah.
Plus a few lols. Throw in some chuckles. It's important. It creates a good vibe. It's like it's important to have a healthy, I imagine that, probably our podcast being played across the RBA's PA system each week is possibly the highlight of the week for most of the employees in what would otherwise be a fairly droll, mundane existence.
Yes,
so
yes. So what do we do then next? What do you reckon? What do you think?
Well, we've got to keep hiking at least another one after this one. Otherwise, the RBA is going to look a bit foolish.
Okay, you're the only economist in Australia that thinks that, but
that's my prediction.
Yeah, you think? Wow,
I'm backing that in 100%. Forecasting's easy.
It doesn't matter.
It doesn't matter. Like all we're doing now is after 21 out of 30 economists that were surveyed got it wrong. All we're doing now is just going back and talking about, why we were misled or why, and ultimately it doesn't. It's like I mentioned gambling before. It's like a gambler kind of going, oh yeah, but like after they tipped, I don't know,
race 5, number
5, then it loses. It's someone who's still at that point is going, oh yeah, but the form showed that it was definitely going to win. It was definitely going to win. So something else has gone wrong that we don't know about, and that always happens. And you just have to stand by your results. And I think economists, as forecasters, if they're going to forecast, you got to stand by your tips, stand by your results. Yeah. Does this rate rise have any sort of implications for equity valuations? We're talking about house prices.
Yeah.
Does it carry across into my portfolio as well?
Well, I think it's interesting in the sense of like markets are now pricing in rate cuts. They're thinking that both US and Australia have gone too hard, and we're going to have to reverse course very quickly. We're talking about 50 basis points by the end of the year in Australia, which would be quite a turnaround. And talking about 4 rate cuts in America, which would be an epic turnaround, given there's there's only really 6 months to sort of deliver those on.
By the end of the year?
By the end of the year. That's what, I mean, bond markets are a bit funny, but that's the market's best guess.
They know that the RBA cut the number of meetings they're having, didn't they?
Oh, they haven't.
Well,
that's not in policy yet. That's just still the recommendation phase.
Oh, okay, right.
Yeah.
Very good.
Yeah, but like you look at the current rally. So S&P is up 15% since October. ASX is up 11%. So doing pretty well. So some people say that, well, that's based on the view that we've got rate cuts are coming. That we'll get through the tightening cycle quickly and we'll move quickly into rate cuts.
Right.
I don't know. That's starting to look like a bit of an iffy bet, I think, because it's quite possible that we might even get another one, maybe two from the RBA's language, out of the RBA this tightening cycle. And then even then, once they're done, like how long till we sort of reverse course? We could sort of, inflation gets a bit sticky. It doesn't come down as quickly as we like. The economy does okay. A lot of economic indicators are still looking all right. So we're not baking in a recession yet. So, maybe cuts aren't coming as soon as the markets think. And if that's the case, and if that reality lands, then if that run up we've had in the last 6 months or so has been based on the idea that rate cuts are coming, as that view evaporates, we might see that run up unwind.
Right. Where does that sentiment come from? Does it come from, we've talked about forecasting a lot, but is that what it's based on? I mean, is there other information or is it just people sitting around going, well, I reckon this is what's going to happen?
What's
the
the
markets do that collectively?
Yeah.
Like, I mean, is it like, are we talk? I don't know where the information comes from. But it seems like it can come from expert predictors or expert sort of economists, or does it come, or does the market sort of, I don't know, the market, I've never quite understood how the market thinks as a whole. We talk about, well, the market thinks this and the market thinks that. Or how does the market formulate the market's decision? It's not a single entity.
Do you know the jelly bean counting study? The fair game competition where you had to guess the number of jelly beans in a jar. Yeah. The chances of any one guess being right are, random. But if you look at the distribution of all the guesses, the center, the average, is very close to the actual number. And what tends to happen is that you have high guesses and you have low guesses, but they all tend to cancel out and your average ends up being actually quite close.
Right.
So I think it's a bit of that in the market. So you look at sort of what people are willing to pay for stocks right now. Some people are willing to pay too much. Some people aren't willing to pay enough. But on average, the idea is it kind of reflects the most likely outcome going forward based on the information that we've got.
Right. And so then when we say the market is pricing in a rate cut, we're saying the cost of the stock, equity, whatever.
No, that's out of the bond market. So when we're talking about
the
pricing,
bond market.
We're talking about rate cuts because bonds are a bet on interest rates.
Right.
And so because that future's in there. So what people are willing to pay for certain bonds reflects people's idea of where rates are going to be. Yeah. But
Right.
it can also, there's also a risk element in there that gets factored in, which... But I don't know. So, but more or less, that's what you can say. But it's the bond markets. It's not what people who only trade equities think when we say that. When we say the market's pricing in a rate cut, it's only what bond traders are willing to pay.
Okay, good. Well, I think maybe we'll make a note for future episodes that if we're ever struggling to have things explained, if we could relate anything back to lollies and kind of candy and use that as an analogy, we'll be in much better shape.
Yeah, your confectionery and gambling guide to the economy.
All right, Thomas, the banking crisis, I thought it went away, but it's not gone away. What's going on with banks?
Yeah, so we're talking about America here. So a lot of wobbles around PacWest Bank, based out of Beverly Hills, as it is, and some sort of worries about Western Alliance Bank out of Phoenix. So we've had 3 bank collapses in the past 2 months. So it's 2 months since SVB, Silicon Valley Bank collapsed, which we talked about at the time. It was big news. We've then had 2 more since then. And now there's worries building around these other 2 banks. It's not going away, definitely not as quickly as the government would like. And then we had this report from out of the Hoover Institution by Professor Amit Seru, and a group of banking experts. And he reckons that there's 4,800 banks in the US, quite a lot of banks. US has a lot of banks relative to the population, but 4,800 banks. Of those 4,800, 2,315, like almost half, are currently insolvent, that they have assets worth less than their liabilities.
Sorry, go back. How many out of that 4,000?
2,315.
So about half of them.
About half.
More than half are insolvent.
Yeah, a bit less than half. Insolvent.
Right.
Yeah, so they're sitting on assets that are worth less than their liabilities.
Gee. I'm no expert, but that sounds bad.
Yes, yeah, we can say that's bad. He reckons the market value of their loan portfolios is $2 trillion lower than the stated book value.
Wow.
Yeah, so he says Professor Amit Suri says it's spooky. Thousands of banks are underwater. Let's not pretend that this is just about Silicon Valley Bank and First Republic. A lot of the US banking system is potentially insolvent.
Is this new news, or is this like, have we just all, like, we've always known this and we're okay with it? Like, as in managing debt and things like that?
No, this is concerning. Concerning. A bank shouldn't be insolvent. No business should be insolvent. There's no.
I don't know, because you hear about all these companies, these big tech companies that aren't turning a profit. You know, and they're sort of, we're investing in these companies even though they're yet to post a profit, they're yet to do anything significant. They've got a great cracking idea, and we're all in. So yeah, I don't know. I just think it's important to understand if a company's insolvent, is that
a bank? Yeah, it is. It's bad. It's spooky, as he says. Yeah, half the banking system's insolvent. The thing is, like, they've calculated this, so they're not technically insolvent. If they're technically insolvent, you're not allowed. I don't think you're allowed to trade. I think that's the case with the bank, but you should be wound up. You should go into bankruptcy. But they're not. They're insolvent on their calculations, but not on their stated book values. So what's going on, he's saying, is that, like, we talked about this with Silicon Valley Bank with their bonds, and their bonds, were losing value because interest rates were rising, and the bonds were what their loan book was based on, which isn't a problem because they didn't register the losses, because you can classify your bonds two ways. They can be available for sale, in which case you've got to mark to market, you've got to price them at their current market value. Or you can say you're holding them to maturity, in which case you don't have to price them at the current value and you just leave them on your books. And that's okay as long as you don't have to sell them. And if you have to sell them, then you've got to sell them at market prices, and then you get into trouble. And that's what happened with Silicon Valley Bank. There was a run. People wanted their deposits out. They had to sell their bonds, which meant they had to sell those bonds that they were going to, had classified as hold to maturity. They had to sell them into the market. And they sold for a loss, and then they went under. I
think I know the answer to this question, but when the bonds reach maturity, does that result in the sale of the bonds, or are you just kind of giving them back and they're giving you the money? So is that So you don't have to worry about when your bonds reach maturity, because it's already been predetermined what the price is going to be at the end, right?
Yeah. That's right. That's right.
Okay.
Yeah.
Cool.
Yeah. So what he's saying is that, because a lot of these small lenders are doing what Silicon Valley Bank did and just classifying these as hold to maturity, they don't have to mark them down. So which makes their book value look better than it actually is. Yeah. The other thing is the commercial banking sector. So they've got the commercial real estate sector, that they've got loans to the commercial real estate sector. That's slumping, but they haven't marked to market their commercial property lending.
Right.
Yeah, and they're saying, like, commercial property slumping. Most analysts seem to predict that commercial property values are going to fall further.
See, I'm hearing a lot of excuses. I'm hearing a lot of but per our previous conversation about interest rates and predictions, I'm hearing a lot of but things will, don't worry, a win's just around the corner.
Yeah, I mean, it's a bit like that. It might be okay. Like, if they can hold the bonds to maturity, they'll be okay. And if, the commercial property sector doesn't, the bum doesn't fall out of that, and they don't end up with a whole bunch of bad loans on their book, If commercial property prices start to rise or they don't fall as much as people expect, they might all be okay. But yeah, if it gets a run on, if confidence starts to evaporate and people start to pull money away from the small regional banks, then it can move quickly, because if they've got to meet the market where they're at, they can't. They're relying on time to remain solvent. Right now, they're not actually solvent in practice.
Yeah, and they may not have time. That's where the run on the bank takes away the time variable. So you've got, at the moment, they're fine because one of the variables in the equation is time, and as long as time stays at what it is, they're okay. But if the run happens, everyone comes and says, we all need our money, you lose all that you have to deliver now, you lose time, and now your equation doesn't look so good.
Yeah.
I just did a quick Google because I heard on the radio this morning. So PacWest Bank is up 80% today, its share price. Today.
But it was down 90% last week.
Yeah. Still. If you bought the dip, you'd be happy. So I keep hearing credit crunch.
Yeah.
Is this what do we mean by credit crunch? Is that the definition then? The credit crunch is
a credit crunch in sort of broad economic terms is when banking conditions tighten independent of monetary policy. So for lending conditions can tighten because the Fed or the RBA is raising rates. But credit conditions will also tighten when the banks go, oh, you know what, we're a bit overextended here. We're going to start winding it back. We're going to, really look at the quality of our loan book. We're only going to lend to super high quality lenders. We're going to lend less than we otherwise would. We're going to demand more collateral. All these little things that they can do to sort of protect themselves if they're feeling overexposed. But what that does is reduces the amount of credit available in the economy. And because so much economic activity is financed by debt, if there's less credit available, that tends to translate into less economic activity. And so you can get a credit crunch can create an economic downturn. Is sort of the idea.
Yeah, okay. Right.
Yeah.
So debt's okay as long as it's not the banks that are in debt. Is that what the takeaway is here? I mean, the banks are always in debt, I suppose, to someone.
That's their business model.
So okay. So the insolvency is not a debt situation. It's more of a
I mean,
all that money's tied up at the moment.
Yeah. I mean, they're in a jam, and it's. I mean, even if it just remains like contained to the regional banks, the small regional banks, they account for 40% of US banking credit. So it's still a very sizable whack. And in that report, they had one of the 10 most vulnerable banks that they looked at was a global systemic entity with assets over 1 trillion. So they're large. We're talking about some large banks here.
Right.
Yeah.
And if they fail, even if they're small banks, if they fail, then it's got to go somewhere, doesn't it?
It does.
We heard about JP Morgan buying up Silicon Valley Bank.
First Republic.
First Republic, sorry.
Yeah. I mean, and that was interesting because the JP Morgan ended up buying it, but only after the government committed to give them $15 billion and a whole bunch of cheap credit.
What, to give JP Morgan?
Yeah. Because apparently a whole lot of potential buyers looked at First Republic and then looked at their commercial real estate book and went, not touching that.
But JP Morgan said, well, we'll take it.
If you give us 15 billion.
If you give us 15 billion. I would have taken it if you gave me 15 billion. Well, so what does the Fed do now then? They can't be just giving off 15 billion every time a bank falls over and giving it to JP Morgan or Chase Bank or some big bank. Lehman Brothers, they still around?
Lehman Brothers. No, that's right. I mean, the Federal Deposit Insurance Corp or whatever that's called, the FDIC. That's only got so much money, so then you need to bail that out, which would be all right. But you can buy your way out of a banking run. So you can just throw money at a bank. If a run starts to build, you just throw a heap of money at it and say like, "Nah, you're all good. Everyone's fine." And people go, "Oh, okay, we can relax. We're going to get our money," and you stop the banking run. But deposit guarantees don't fix solvency issues. If the problem is fundamentally there's a solvency issue, and if economic conditions don't improve in time, and then the banks actually start have to marking their assets to market, then they're going to have to say like, oh, actually we're kind of a bit close to insolvent. At which case their bondholders and creditors start pulling out, and then the bank collapses. And it's not a run; it's just like people going like, don't want to touch an insolvent bank, thanks.
Yeah, wow.
And that puts the Fed in a really tricky spot, because the way to fix it is if it's bonds and commercial real estate, that's creating your problem. The way to fix it is to cut rates, because you cut rates, that pops up your bond asset values, and it increases commercial property prices.
Right.
So
it comes back, that's how it ties back to rates.
Yeah, the Fed could potentially fix it. I mean, they created this problem with super cheap money. This is sort of the story with it. But you've got inflation, so they don't want to cut rates.
Hang on, they created it with super cheap money. So low interest rates.
Low interest rates, yeah.
But now it's a problem because of high interest rates?
Yeah.
Right.
So like
okay.
there's a heap of money going into commercial real estate because money was super cheap. People were buying bonds because they thought they were stable and safe. They were safe but didn't end up being stable.
Right.
That's sort of like we're dealing with the consequences of that now.
Right.
So the Fed could walk it back and go like, okay, sorry guys, we're just going to walk this back and help the banking system out. But if there's inflation, and the Fed's got to fight inflation. And if they bail out the banking system by winding it back while inflation's hot, then they lose all credibility with inflation.
Oh, I take it back. Economics is hard.
Yeah.
All right. I reckon I need a break. I might even go and have a little lie down before we do the second half of the show. We're going to be back after the break talking Chilean lithium as well as the Cleanaway driver shortage. We will be right back with more Comedian versus Economist right after this. Welcome back. You're on Comedian versus Economist. You can, of course, send us an email, cve@equitymates.com, or via the website, equitymates.com/CVE. You can, of course, also send us a message via Instagram and Facebook @CVE Podcast. And before we get on with the second half of the show, perhaps you'd like to fire up your podcast app and leave us a little rating or even a review. That would be much appreciated. It does help us out in ways that you may never understand, but just know you've done something good. On with the show, Thomas. Chile has big plans for their lithium sector.
Yes.
What's going on? This is where I focus my attention for this entire break, is how to pronounce Chile.
No, yeah. So yeah, big plans. So they have the second largest discovered reserves behind Bolivia in the world, and they're the second largest lithium producer behind Australia.
Right.
Yeah, and they're planning to nationalise the country's lithium production.
What does that mean?
Basically, they're going to bring it under state control, bring it under government control.
Oh, okay, right.
Yeah. So, it got reported as nationalisation. Strictly, that would mean when the government takes over the companies operating in the space. They're not doing that. They're just going to say, going forward, all lithium projects are going to be run as public-private partnerships with the government managing the project.
Right.
So, and the idea is here that they want to capture the benefits of their lithium resources and help build their local economy. They want to sort of do some more value adding rather than just shipping raw lithium out. They want to start scale, do some value add, processing, right. And use it as a tool for economic development. And they're feeling that without owning the projects and running the projects, that they're just giving too much power to the foreign companies doing the actual mining and not capturing enough of the benefits.
This might affect a company called Lithium Chile, which ironically is a Canadian company. Huh. Yeah, there you go. I Googled that before on my research for this show. Lithium's in the earth, and I guess the state owns the earth. Without getting too philosophical about who owns the earth. But the state owns the earth. So therefore, I guess they're saying, well, we want to be compensated. You can't just be... But they'd sell the title to the lithium companies to dig it up, wouldn't they, for the mining?
I think they would work in a partnership. Public-private partnership seems to be the model they're proposing.
It's a good idea. Should we do the same for the Australian mining sector, or do we do that already?
No, we don't. And I think it would be a good idea. Yeah, I mean, it's interesting. The budget's coming out tomorrow. We're not, I'm not talking about it too much, but One of the things is that they're raising the petroleum resource rent tax by going to raise an extra $2.4 billion, which is fairly weak. Like, it's pretty soft. So you think about, the LNG industry, the gas industry will bring in $91 billion in export earnings this financial year. That's up threefold from over the last year. So they're making an extra $60 billion this year on the back of the war in Ukraine. Nothing actually happened. They're just war prices have gone up, but they've made a killing on that. So they're booking an extra $60 billion. We're paying heaps more for electricity. Electricity prices are through the roof. They're driving a third of the inflation, which is then giving us higher interest rates because we're fighting inflation. So we could have avoided that if we had owned those resources and we didn't have to book that profit. That would have just been tax revenue and it would have been great. Right. We could have just kept energy prices lower and avoided the whole inflation story. But in the end, what we've decided to do is, of that $60 billion, we're going to raise $2.4 billion over 4 years. So we're going to take about $500 million of that, $60 billion that they've made. We're then going to funnel that back through to energy relief, giving low-income earners $500 each, which will then go back to the energy companies to pay the bills.
Yeah, right. See, that's going to hurt the energy companies, isn't it?
Yeah.
They lose that $500 million out of the 60.
60, yeah.
Only to be without it for literally could be up to days, even weeks before they get it back through low-income earners. That's
good outcome, that one. Yeah, they're pretty happy about it. Actually, it got announced, and they're all like, "This is pretty reasonable." And I was like, "Come on, yeah." So they've made an extra $60 billion off the blood of Ukrainians. And it jacked up our energy prices. We're paying more for energy. We're paying higher interest rates because of it. And then all the government does is takes a teeny bit back and funnels it back to the companies.
So what should they have done though? Like, I mean, what's the...
Nationalise them.
Nationalise them?
Oh, I don't know. I mean...
Well, I guess, like, I mean, the war in Ukraine, right? It's a tragic thing. Like, they didn't start the war. So it just it happened and that pushed the prices up. And then...
And they just made heaps of profit out of it.
So what should the government have done at that point, though? Should they have just, like, super profits tax?
Either super profits tax, which the UK has gone down. Yeah. You look at Norway has like a resource tent. They capture a huge amount of revenue from their oil and gas industry. We capture barely any relative to Norway. It's embarrassing. So you either have that super profits and do it seriously, not this $2.4 billion fiddling around with the PRRT, which even if it comes true, and historically it tends to under-deliver in a pretty epic way, or you have a price cap, which is what Western Australia has, which means a domestic gas reservation, which keeps the price lower for locals. And says that you got to supply the local market at reasonable prices before you start exporting it all offshore and making heaps of money. Looking after Australians. Yeah, that's what they should have done.
So why didn't they?
I think because they're captured by the resource industry in a pretty epic way. Yeah, I think Labor...
It's just your standard run-of-the-mill corruptive sort of behaviour.
Yeah, I think so. They write their own code of conduct. It's weak. And Labor's, I think, is scared because, they smashed the Rudd-Gillard government, the Abbott, that whole story. That was all funded and driven by the resource industry. Right. Yeah, I don't know. I don't think they're not doing Australia any favours. I reckon nationalise them. My hot take.
All right, Thomas, finally on the show, we got an update from Cleanaway. Apparently they're not asking their executives to drive garbage trucks anymore. What's going on? I didn't realise they were.
No, yeah, well, maybe not quite executives, but they noted at the start of the year they had a bit of a truck driver shortage for their garbage trucks.
A driver crunch.
Driver crunch, yes. So, and they were asking...
Not a thing.
No. They were asking their managers and supervisors to step in and drive the actual trucks. I don't know about, the C-suite. I think getting their hands dirty.
No.
But there was a shortage. They had 773 open vacancies at its peak,
Right.
saying that normal is like 300 odd or something.
Okay.
Yeah. Interesting point there. They're saying we can't get to zero. You know, they never have no vacancies. There's always some churn going on in that job market.
Right. A bit like full unemployment.
Yeah, exactly. Yeah.
Look at me just ripping out economic terms like in conversation.
Yeah. Yeah.
Right.
But the CEO, Mark Schubert, last week said that they were getting on top of that. They're now down to, from that 773, they're down to 622.
Why was there the shortage to begin with?
Yeah, I don't know exactly. I think immigration, the closed borders was a bit of a story. Mark Schubert was saying a lot of their new drivers, it's the first job that they'll have in Australia.
Right.
Yeah, so I think maybe the closed borders was helping that story maybe. Also it's just a very tight labour market, and I think maybe, the truck drivers were they had to compete harder to get the workers.
And let's be honest, not the most sought after role
going
around,
Doesn't have that mystique of bond trader, does it?
Graphic design. But I tell you what, AI is not going to, not going to come for your job. Oh, mate, well, no, it probably will.
Self-driving
trucks. Yeah, sorry. Bad news.
But yeah, I mean, I guess it pays pretty well. Like you got to do a 12 to 16 week training program to become a driver from scratch.
Right.
Like if you have your heavy vehicle driver's license already, I think it's less. But
right.
Yeah, there's a 16-week training program. One of the things they did, which was interesting, is they launched the Female Driver Academy in early 2022. They recognised that they didn't have a lot of women driving the trucks. They've got 2,600 truck drivers. They've now got that number up to 166 thanks to the Driver Academy, but still very small percentage.
Pretty shrewd business move too when you think about it. They'll be able to save about 13.4% on average thanks to the gender pay gap alone. So
don't accept less pay, ladies. But no, smart. They found there's the untapped niche there. Get them involved. So yeah, that was their strategy and seems to be paying off. He reckons.
Brilliant. All right, we might leave it there. Thank you so much for tuning in once again. Don't forget, FinFest 2023 is locked in, November the 11th, 2023 at the Carriage Works in Sydney. We hope to see you there. But for us this week, that is all. It is bye for now.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.